As we look at this forecast, the first thing I want to do is start with the actual Fed. The Fed will be very influential in the overall market in housing and with mortgage rates. Therefore, as we explore the Fed, they gave us probably one of the most recent dot plot based on the summary of economic projections for where they think the Fed funds rate will be in 2025. Now, why is this important and why am I starting here? Well, the Fed funds rate is currently at 4.375, and each of these dots is representative of one of the 19 Fed members and where they think the Fed funds rate should be in 2025. Now, as you can see, one Fed member thinks that there should be no change to the Fed funds rate. 3 Fed members think the Fed funds rate should be cut down from 4.375 to 4.125. And here's the median. 10 Fed members are looking at 2 quarter-point cuts, and they think that the Fed funds rate should be about 3.875. There are 3 Fed members who are looking at 3.625, 1 at 3.375, and 1 at 3.125. Now, our forecast and where we think the Fed funds rate will go this year is here. The Fed is actually telling us that 2 cuts are imminent, but we think there could be multiple cuts this year. Let me explain. The main reason that I feel that the Fed will actually cut rates further is because I believe the unemployment rate has a good chance of increasing throughout the year. At the beginning of 2025, it currently sits at 4.2%. And when the Fed gave us their projections, as you can see by this big bar here, most Fed members felt the unemployment would stay between 4.2% and 4.3% in 2025. 5 members think it will go a bit higher than that, which you can see was the other bar here. And they think that it will be between 4.4% to 4.5%. Now, what does this tell us? Well, what happens if unemployment does get worse than what they project? Meaning, what if unemployment does go up from 4.4 or 4.5%? As 5 members project, then 14 members will be surprised and they will need to change their thought process behind their Fed funds rate projection, which may alter the cut they choose to make to the actual rate. You see, if the unemployment gets to 4.6 or more, then all 19 Fed members will be surprised, causing them all to go back to the drawing board. They may decide they need to get more aggressive with rate cuts. While the Fed gives us their guidance and the market responds, one thing we do know is that they change their minds very, very quickly. A rise in unemployment rate could cause them to change their minds quickly, especially if you get an unemployment rate above 4.4% or 4.6%, because that changes their outlook on the economy and their forecast. And that is the main reason why we need to start these projections and these predictions with the federal funds rate. Now, another driver is, of course, inflation, because it's an important factor and has remained somewhat stubborn. Remember what inflation is. It's just too many dollars chasing too few goods. Now, why is this important? Well, when the Fed measures inflation, they look at a personal consumption expenditures, or PCE, and they like to look at the core rate, which removes things like food and energy prices because they're more volatile. Now, the most recent data shows, specifically as of November 2024, has core PCE at 2.8%. That's well above the federal target of 2%. But there's a reason to believe that that figure could be overstated. Why? Well, because of a big component, shelter, which weighs about 18% that of core PCE. Now, shelter is rent, owner's equivalent to rent, and things like that. And based on this report, shelter is increasing at a rate of 4.8%. But could it be that there's a discrepancy and the lag in the way the Fed sees these numbers from the BAA and BLS? Let me explain. If we look at something closer to real-time rents, for example, CoreLogic and other rental indexes, they're showing a year-over-year number going up at a rate of right around 1.7%. Which stands to reason, right? If you have properties that are staying vacant, you're more likely to say, hey, I'll give you a deal on that property. And there's more pricing pressure on renewal rents because landlords know it's a hassle for them to go through the expense of moving, and they have probably a little less leverage to raise rents. But still, according to these real-time numbers, we're increasing at a rate of 1.7% blended year over year. Now, the difference between what the Fed is counting in their core PCE based on shelter and what real-time figures show, pretty big difference. I mean, it's 3.1%. So if you took this 3.1% overstatement and multiply it by 18%, which is the weight given to this particular area on core PCE, it tells you that because of this lag, core PCE is being overestimated by about 0.5%. So instead of a reading of 2.8%, where should it then be? Well, it should be closer to 2.3% without the shelter delta. I mean, it's still above the Fed's target of 2%, but is a lot closer to it. And if things start to settle down a little bit further, we could get closer to that 2% mark. And I think this is the reason why the Fed is more hesitant. And the bond market would really like that too, because remember, inflation erodes the return of fixed payments that you receive on a bond, like a mortgage bond. So lower inflation is always good news for bonds. Now, let's just go a little bit further here and maybe talk a little bit about why we feel so optimistic. Not just about the perhaps lag in the data that the Fed is looking at, but specific trends. Take a look. Now, please note, trends are not a straight line, but this is definitely a clear trend shown in this particular graph. As you can see from the top left to the bottom right, the numbers are actually improving. And we've been actually getting readings for this particular report of below 3.7%. So help could absolutely be on the way for mortgage interest rates as it relates to the core PCE. Because if we continue to get readings in this vicinity, which is what we see in real time, then as the older numbers get replaced with new lower numbers, it will have a very big impact on core PCE and the overall projections. I mean, take a look at the numbers outgoing for December 23rd, 2023, January 2024. We will be replacing these numbers with lower numbers. And because of the high weighting given to this particular area of PCE, we should start seeing that help the overall core PCE. Even as we looked at January 2020 replacements, which we'll see in February of this year, we could start to make some real significant progress here. And as you can see, these numbers are obviously getting beefier, so we could conceivably see core PCE get lower and lower and more favorable for the overall bond market. And perhaps, along with the job numbers, the labor numbers start to change some of the minds of the Fed members to make them more willing to cut rates. Now, while it'll be beneficial to see the rate of change decline in inflation that you see in this red line, the burden that consumers are expecting doesn't really get easier. And why is that? Well, because while the rate changes is more helpful, that is not declining, it is still an additive to the inflation that's already there. In other words, prices are going up even more, but just as at a slower rate. This blue line shows you the cumulative impact, and it's a great visual for you to anchor yourself on, because that is why consumers are complaining and feeling this pressure. They have to carry that burden. Even though the rate of change is lower, the burden continues, and obviously we're feeling it. Now let's take a look at the labor markets a little closer, because we know that the Fed is going to pay attention to this, and it could be a key also to the interest rate reduction. A quick look here at the labor market show that the unemployment rate is rising. Now remember, we just told you that it currently sits at 4.2%. But it would not take much to see these numbers climb back up to 4.3 or 4.4. And as you start getting to that 4.5 and 4.6 range, some Fed members are going to be surprised. Another thing to look at is once you're unemployed, it seems like it gets harder to find employment because of the duration of receiving unemployment benefits is getting longer. The median duration of unemployment has increased 21% in just the last 7 months. This is a pretty sharp increase, although we have seen it slow down and steady increase these past few years. That should be something for us to keep an eye out in the coming months. Then there's closures or announced closures. I mean, these are businesses, stores that announced closures in 2024 versus 2023. That's up almost 70%. Now, it takes time once it's announced for these stores to actually close. But just look at the actual number of the store closures. Remember, there are multiple amount of employees in each of these stores. For example, you might say that there's only 65 Macy's stores closing. Think of everyone who works in these stores and multiply that by 65, right? I mean, that's a lot of unemployed people right there. And that's just one of the names on these lists of the overall unemployment numbers. It tells us that the labor market is not quite running on full strength right now. At the same time, the number of job openings has also declined. The JOLTS report, or the Job Opening and Labor Turnover Survey, shows us job opening trends. 2.5 years ago, we had 12 million job openings. We're now at 7.7. Despite a little recent blimp up, the trend clearly tells us there are fewer job openings. There's less job equals less demand for workers, longer duration of unemployment. And it all starts to paint a picture that we can expect higher unemployment rates in the next coming months. Now, how does this impact mortgage rates? Well, if the Fed is going to be inclined to cut rates to combat inflation and unemployment, could that benefit mortgage rates? Well, yeah, let's take a look. I think that the 10-year Treasury could reach a level of right around 3.6%. It's about a percentage point above that now, but I believe that we could see that decrease again because we saw those lower levels again in August and September of last year. Meaning those dips were triggered by encouraging job numbers and inflation continues to improve. That also could help bring this number down. We could see 10-year Treasury at 3.6, 3.7 sometime during 2025. But how does that impact mortgage rates? Well, the spread between the 10-year Treasury and the 30-year fixed rate mortgages is something to obviously keep in mind. Now, it's not set in stone, but there is a range and history gives us some clues. You see, these green parallel lines here, this shows us a pretty long period of time. The last 30 years, the mortgage rates have risen above the 10-year Treasury by a range of right around 1.6% to 2% most of the time. Here's the great financial crisis. Here's COVID. Now take out the wild times, and you can see that is a reasonable range. After the great financial crisis, there's a move up and a counter move lower. Here, the big move up, and here, the counter move lower. Back in October, you can see that we had reached a spread of right around 3.1% when the 10-year Treasury was at 5% and the spread was at 3.1. Add the 5% 10-year Treasury plus 3.1, let me see the mortgage rates were right about 8%. At that level, as you can understand, there was very few people that were thinking about purchasing a property, but yet we still saw competition. More on this later. But the servicing premiums, or the servicers, knew that these interest rates were most likely going to be refinanced at some point in the future. Now, why is that even important, and why does it even matter to look back and understand that spread? Well, if the job numbers come in and the unemployment rates are higher, and the Fed continues to actually cut, while at the same time inflation coming down, we think mortgage rates will come down because this spread should actually start to narrow. And this gives us a basis for forecasting where rates will go in the next 6 months. So if we do take our target of the 10-year treasury, kind of using that same logic earlier, in that range of around 3.6%, by adding that spread to it, which let's say narrows to 2.5 or 2.25%, it gives us a basis to say, hey, look, somewhere around 5.75 to 6% range for a mortgage could be very realistic. And if that happens, as we've seen in the past, and as we approach those levels, we will see an increased amount of activity for refinances and purchase transactions in the overall real estate environment, which is critical to note because that window will be very small. And if you have a mortgage that is within the other spread, in other words, an elevated rate, it might make sense for us to prepare in anticipation of those rates coming down. Now, speaking of real estate, let's look at the actual 2025 forecast because this piggybacks great with mortgage interest rates. Now, real estate has done really, really well, even with the higher rates and even with all this information that we're giving you earlier today. And that, though, because comes down to a simple and basic of economics, which is too much demand and not enough inventory. That's why real estate has been so resilient, despite of the amount of job losses that exist, despite of higher interest rates in the overall market. And even though mortgage rates have moved up in the past, home prices continue to move up simply because of overall supply and demand. Now let's zoom in a little bit deeper and let's take a look at overall housing. This is a view that not a lot of people get to look at, so I hope it's actually helpful. Out of the total amount of households in the United States, 136 million of them, 45 million are actually rented and 91 million are actually owned. In equity, well, clearly no equity is there if you're renting. But if you own a real estate, there's a massive amount of equity available. Homeowners, get this, are sitting on $37 trillion worth of equity, an average of right around $400,000 per household. Now, if we were to break this thing down between those that are free and clear and those that have mortgages on them, about 38% of them are owned free and clear. So why is that important to note? Well, these individuals have no sensitivity to the increase in mortgage interest rates. They sell their home, they buy another one in cash. And this is helpful to understand because if you're buying real estate, you realize that there's a cost demand from buyers who are not sensitive to mortgage interest rates. These individuals are also sitting on a lot of equity, $20 trillion worth to be exact, with the average amount of about $570,000 per household. Now, take 80% of this number, somewhere in the neighborhood of $450,000, and that's what can be pulled out of as cash. Now, there are 56 million mortgage homes, or about 62%. They're sitting on a lot of equity as well, 17.3 trillion, or an average of 311,000 in capital that they could pull out as cash out, or about $210,000 on average. Now, why does this matter? Well, outside of the fact that there's equity in the actual properties compared to years before where there was negative equity in homes, could this be an opportunity for you to maybe consolidate debt by pulling money out of the actual mortgage and consolidate it into the actual loan? Does this mean that you can pull a home equity line of credit against the house and actually do some work on the property? The possibilities are obviously endless and they're tied to your overall specific picture, but let this give you encouragement in terms of the strength of the overall housing market, despite all of the information that we obviously learned about earlier. Because very few people have negative equity anymore. About $300 billion of negative equity on a million homes. To put that in perspective, there was at one point in time where 25% of homes had negative equity during the Great Financial Crisis. But thanks to home appreciations, We've seen much lower negative number, much lower negative equity sense. Now, if you're a skeptic like me and are worried about just, the different components in the overall marketplace right now, one of the questions that obviously always comes up is this going to continue? This information and this overall demand for supply will continue. Let me explain. There are 71 million baby boomers, 65 million Gen Xers, 73 million millennials, and 69 Gen Zers. Now, what does this mean and why does this even matter? Well, the average age of a first-time home buyer is 33 years old. Okay? Now, as you can see here, baby boomers have the highest share of home ownership. Not surprised to see only 8% of Gen Zers own a home, right? Because they're still quite young. That said, it's just a matter of time, right? Because the median age here is about 20. But as you go through time, for example, millennials, when they were at age 30, the homeownership rate accounted for right around 33% with millennials. When millennials hit age 40, there was a 55% homeownership rate. And when you blend the two currently, because their median age is somewhere in between that right now, around 35, they are at a 45% homeownership rate. Now, why does that even matter, right? That's what a skeptic would say. Well, look at the actual demand in the overall opportunity that the market is obviously seeing. Let's look first at millennials. We just told you there's about 73 million of them. And of these 373 million, there's a median age of 35. The home ownership rate currently is at 45%. But let's look at the group age at 30, okay? Median age, for example. When their median age goes up from 30 to a median age of 40 for these 40 million homeowners, you know what's going to happen to homeownership rates? It's going to rise by 22%. 22% on 40 million individuals that are millennials means that we're going to have 8.5 million more homeowners. Not all of them will be individuals, of course. Some will double up. We understand that. What do you think that will mean for appreciation in the overall market? What do you think that will mean for the people that invested in real estate and are seeing that appreciation go up? I can certainly say this. Those individuals are obviously going to be the benefactors of higher appreciation rates on their actual home. Now, the other wave that I think is important to also know is the actual Gen Z wave. Because we said that their median age right now is 20, and there's 69 million of them. And their homeownership rate right now is only 8%. So as these people go through time over the next 10 years, if they follow, let's say, the millennials 10 years from now, and their median age is no longer 20, but it's 30, they will actually follow the actual millennial group, and they will be looking at a homeownership rate of 33%. That's a jump of 25% on 69 million, and that's 17 million more homeowners. When you combine these two, we're talking somewhere in the 25 to 26 million more homeowners. That's a lot of people entering the overall market. And we're just not building enough homes to keep up with the overall demand. Let me just show you here. Let's show you what's going on. Let's start with active listings, okay? Active listings are going up, but from extraordinarily low levels. And you may see that active listings were high, but zoom out. As you can see, pre-COVID, the levels of active inventory that been somewhere around 1.1 to 1.3 million in this period, that's been the range. So from this level of currently around 1.2 to where we are right now, that's a 21% drop off in inventory. The population hasn't changed since. Do you know that since 2018, the population of the United States has risen by almost 12 million people? So that means more demand. And this is all the reasons why real estate, the overall market, has been so resilient despite affordability issue, our prices, mortgage interest rates, unemployment rates, you're still seeing home appreciation. And that's rather significant. So the myopic view might be 27% more inventory, yes, but when you take a more broad view, it's a predictive view. You can see that there's clear reasons to believe there's tight supply with growing populations. And if we look at the demand as far as the households being formed, you can only see that 1.9 million is where you are right now. We've been in that range for a long period of time. Clearly, the COVID period here caused some noise, but you can see it's been pretty steady in this range. We're a little below 2 million, above 1.5, and is where we are as far as the level of households being formed. Now let's look at these two charts together. You can see that we are at a level where there's just too much demand and not enough supply. And that's why home prices are going up. Now, let's take a closer view here because we know that since 2023, interest rates have risen also rather significantly. Home prices have gone up and affordability has become more difficult. But why do home prices keep rising? Again, it comes back down to the basic economics of supply and demand. Too much demand, not enough supply. And this is the reason prices continue to rise amidst higher rates. We have too much demand here, and 1.9 million or so, and it's just not enough supply of 1.4, 1.5 million a year, or maybe around 1.3 million. This is why we will continue to see home appreciations grow. So what's our forecast for real estate? Our forecast is this: 4.1% 2025 year-over-year appreciation. Not exciting, but definitely not declining. Steady would be the way I would describe that. Because if you tell me on a $500,000 home, that's a $20,000 gain. If you put 10% down, that's a 41% appreciation on your investment over time. Also, let's take a look at cumulative over time. Over the next 5 years, I think that's very realistic to see 30 to 35% appreciation. Or on a $500,000 home, it's $150,000 to $175,000. Now, to close it all out, and let's recap our forecast. Home appreciation, 4 to 4.5%. Core PCE inflation in the range of 2.1 to 2.8. I think the bond market is likely going to like that, and changes are going to be in place, considering the overall labor market. The unemployment rate going up to 4.5 to 4.6, which is going to surprise some of the Fed members. And as a result, we think that the Fed will respond by cutting rates, which will help mortgage interest rates in the long term. And we think that's going to happen. There's going to be a response to the overall market by cutting rates. They told us they'll cut twice, about 50 basis points, but I think it's going to be closer to 100, as we discussed earlier today. And that should keep long-term rates well within the 5.75 to 6% rate sometime in 2025, which would bring relief to the overall buyers and investors. So remember, for every percentage drop in mortgage interest rates, 5 million more households obviously are going to be entering the marketplace. And that obviously could create a lot of activity. Therefore, align yourself with a team that gives you a strong plan that can move quickly when the right property comes along. Align yourself with a team that can help you restructure the debt if you bought a property in the last 2 years when rates do come down. And ultimately, align yourself with a team that will give you the best price, the best advice, and the overall best mortgage experience. Thank you so much for tuning in. Have a great day.